Good morning. This is Felix with Belleville Real Estate. Today, what I want to talk about is the third part in a series of four, actually, of benefits of investing in commercial real estate. And today, we're going to be talking about loan amortization. So, actually, the principle of loan amortization is often overlooked as a powerful lever that it is for purchasing real estate income-producing assets. And basically, it's like taking a loan or borrowing money from the bank or private money or whichever way you're doing it. And this has often become associated with negative connotations because now you're in debt, you're borrowing money, but you can actually leverage that debt into building a great portfolio. And so I'm explaining to you how and why you should use leverage and debt to build your assets and your investments. So, amortization actually has two root words in it, which is add, which means towards, and mort, which means death. So if we put these two together, it means loan amortization means that it goes towards paying off the loan or towards the killing of the loan. And this is exactly what happens when we use a loan or mortgage to buy an income producing property. So I'm going to explain to you how. So we're going to consider the example that we have $1 million dedicated to our investment portfolio. Okay? We have $1 million set aside solely for investments. So I could go out and put this whole $1 million into buying a $1 million property and buy it cash, I'm not taking out any debt or financing of any kind. And I just put it towards it and it gives me the income back. I don't only have to pay taxes and operating expenses. However, I'm fully dependent. I have $1 million. I put into $1 million property and I'm fully dependent on that property to make me income or be my investment. And so now if it remains vacant, actually the property taxes, the operating expenses of the property are actually going to be a minus for you. So I'm going to explain to you how we can do it a little smarter using loan amortization. So let's say you have the exact same 1 million. If we use a 30% loan to value ratio loan, basically we can say we're going to pay $300,000 towards $1 million property, and we're going to finance the rest of the 70%. So we're actually going to be out $300,000 up front, and now we still have $700,000, the financing, and we have $700,000 of our own that are still in reserves, and we can still do stuff with it. So we bought the exact same property that we would have based on a completely cash basis, but we bought it for $300,000. So that's a really good deal. But now here's where it gets interesting. Let's say we can grab those extra $700,000 and we can actually go do this two more times. So we can go buy the exact same, very similar asset worth $1 million, producing the exact same net operating income, and we can buy two more of them because we have $700,000 in our bank account. So we can do maybe a little higher loan to value ratio or a little lower, depending on what you like. But let's take, for example, we take out the exact same loan. So we're going to be $300,000 out, $300,000 out, $300,000 out. That's a total of $900,000. But now we've bought properties equivalent to $3 million instead of buying a $1 million property. But now we also have $100,000 leftovers for other investments. You may want to buy something else, or put in bonds, whatever you may desire. But now these three properties, the net operating income, if it's all being the same compared to the cash basis that we spoke about, they're actually going to be producing 3 times as much in net operating income before paying off the debt service than the first scenario. And so you start to think about it. Now you literally multiplied your income by 3 just by using the power of loan amortization. And the reason why we want to do this is because you're diversing your risk. You're hedging against something happening to one of these properties. In the case that your cash basis, that property remains vacant, now you, the owner, are responsible for taxes, insurance, operating expenses of the property by yourself, and that's coming out of your own pocket. But now if we have three, the likelihood of that happening, of all three properties being vacant, actually goes down way low. Because now if one property is vacant, the other two, the extra cash flow that we get from those after paying all the operating expenses for those, can actually go towards the paying of these properties' expenses. So they actually cover each other's expenses, if the case may be. Other than that, you're actually building equity, whereas in the other one you've built $1 million in equity, and that's it. Everything else is cash flow. Now, if we use leverage, if we use loans to buy three properties of the same size, the tenants are helping us pay, or building equity, or helping us buy the property worth three properties worth $3 million. And so basically, if you start to look at it this way, it starts to make sense to why to use leverage and not have it be, or have a negative connotation, because it actually is not. It is a very powerful tool that any savvy real estate investor would use, because also the opportunity cost of money. So now, one additional benefit from using a loan that's often not talked about is that actually, let's say that one entity made $100,000 in 1 year in taxable income. Okay, now if you use a loan to pay this off, and let's say during that year you paid $30,000 in interest for that loan towards that property. Actually, interest is deductible, so you can actually take off those $30,000 that you paid from your $100,000 that you made, and now you come to a net taxable income of only $70,000. So this is a great bonus that a lot of people use as an additional lever to use loans. And so this is kind of encompasses what would happen, what are the different scenarios that may happen if you use all cash basis or you buy it with a loan. Of course, there's some more hoops that you have to go. You have to be approved. You have to be able. The property has to pass certain inspections. The property has to be in a good condition. It has to be appraised for that value. But if it is, and you're able to use a loan, then this is much more powerful. It will be way much more to your benefit, and you will build a bigger portfolio because of this. So if you want to leverage this principle, the principle of loan amortization, or any of the other principles that I've talked about here in my series, please don't hesitate to give me a call. Thank you for listening. Have a great day.